What is the difference between principal and interest in a mortgage? If you're navigating the world of mortgages and wondering what the terms principal and interest really mean, you're in the right place. Let's break it down so you can understand your mortgage better. When you buy a home, you typically don't pay the full price up front. Instead, you borrow money from a lender, and this borrowed amount is called the mortgage principal. For example, if you buy a house for $400,000 and put down a 20% down payment of $80,000, the remaining $320,000 is your mortgage principal. Now let's talk about interest. Interest is the cost of borrowing that money from the lender. It's essentially the fee you pay for using someone else's money to buy your home. This interest is calculated as a percentage of the outstanding principal balance. So, if your annual interest rate is 4%, you'll pay 4% of the $320,000 principal each year, which is $12,800, or about $1,067 per month. Here's how it works in your monthly payments. Initially, a larger portion of your payment goes toward interest rather than the principal. This is because the interest is calculated on the full principal amount, which is highest at the beginning of the loan. As you make payments and the principal balance decreases, the interest portion of your payment also decreases, and more of your payment goes toward reducing the principal. To give you a clearer picture, let's use an example. If you have a $320,000 mortgage with a 30-year term and a 4% interest rate, your early payments will mostly cover the interest. However, as the years go by and you've paid down some of the principal, more of your monthly payment will go toward the principal and less toward the interest. Another important aspect is the amortization schedule. This schedule shows how each of your payments is divided between principal and interest over the life of the loan. You can use an amortization calculator to see exactly how your payments will be split each month. In addition to principal and interest, your monthly mortgage payment might also include other costs like homeowner's insurance and property taxes. These are often bundled into an escrow account to ensure timely payments. If you pay extra toward the principal, you can reduce the outstanding loan balance faster, which means you'll save money on interest over the life of the loan. For instance, if you make an extra payment of $1,000 toward the principal, it directly reduces the amount you owe, which in turn reduces the interest you'll pay in the future. In summary, the principal is the amount you borrowed to buy your home, and the interest is the cost of borrowing that money. Understanding how these two components work together can help you make informed decisions about your mortgage and potentially save you money in the long run.